Hi, this is Rohit Srivastav. This is Sunday the 13th of July 2014, and we are entering just after the budget week. I just completed writing the weekly Elliott Wave update on the website, and I discussed the various possibilities. Clearly, the medium term trend has turned down, but the bigger question that people need to be thinking about, and I will also be raising, is whether the longer term trend itself has reversed. Now, because you had such a big run and so much of hope built around it, uh, that question might not get answered instantly. But my sense is, looking at the way all the sentiment indicators set up, which I showed in the long short report for this month, that this is a bigger top. All those indicators definitely indicate that this is a bigger top and not something small that is happening. And if you just see the way the behavior was, not just of all the popular media but everyone in the financial field, the expectations were set so high. And I think specifically, if I was, if you read every day the Economic Times, and you look at the kind of news build-up that they created, identifying things that would get done or should get done, it really created a mental hype. But when you purely look at the index itself, it made a high of 7580 in the month of May, right after the elections. It was a huge bar candle, and usually such bar candles indicate significant trend reversals or continuations based on what price does afterwards. So it did attempt to go above that level twice, first in June for a brief period, and then it fell back. Then it surpassed even the June high for a brief period, and now it has fallen back below that. So it's essentially a failure to stay above that big candle, and that is an indication of reversal. The thing that people say, okay, fine, it's a reversal, but we are still in a longer term uptrend, you should be buying the dips. That's a significant change in psychology that has happened, and it has happened because the markets have run up, and a lot of stocks did much better than the index itself, even the last 2 months since the election took place. And that has changed the psychology of people to start thinking that way, versus what you would be thinking in August when the market was at 5100 and it was extremely oversold. I showed all sentiment indicators at an extreme, and I raised the question that why shouldn't the market go back to 6200. Definitely after that, for some time I was bearish on the markets, and it took the market to go beyond 6400 for me to get a little bullish. Now I say a little bullish because the macro environment essentially did not change, and I was not really sure how you would really do something that would change that. In all my interviews on NDTV, I said fine, the market can go up, but you have two major issues. First one is what would happen on the global front, and when we look at the US markets, and let me come to that a little later. And the second one, which is purely domestic, and that is the macro environment. Now, you're anticipating that a new government can come and completely change everything. Definitely, they have full power to change a lot of things, but it's never easy, And when we say we are purely looking at, so this is what I've been saying for 2 weeks in my media interviews. I said that this budget would be doing two things. The first one is that it would be disinflationary, and the second thing is that it would be policy positive. Now that's a complicated structure that you can have. When you say it's disinflationary, essentially that the government doesn't have money to spend, so it cannot really splurge, and you may expect it to cut back on a lot of things and reallocate capital, but that's never easy, because you understand that the government is a central force. It serves many more people than a couple of powers, and therefore when previous policies are put in place, they are based on a particular mass, a particular vote bank, and you just can't change that overnight. You need to build expectations. You need to convince them that this change is necessary and it's good, and take them along. So that's a process. So I'm not saying that you can't go through with that process, but you can't really jump the gun, and then you think about that the government has actually been voted in on the idea that you don't want inflation. Now, what really happens is, when I started writing the quantitative economic cycle in 2009 for the Indian economy, I said that we are entering a winter essentially on the idea that there's a lot of debt in the country. most people say India's debt to GDP ratio is nothing great. Most economists will say, oh, it's not high, but it's not high compared to where US and probably many other countries have reached in the current counter-type cycle, which is you've never seen such high ratios ever in the history of economics, and therefore if you go back and study any previous cycle, 60 to 70 years back, or the 70-year cycle, you can go centuries back, then you notice that this is a high number, and a lot of the debt essentially got created in the private sector, and we do have a lot of, we have NBFCs, non-banking finance, which used to be huge in the mid-90s. It's probably much more quieter now, but you have many other forms of finance which don't get measured, and therefore when you have high data, I'm sure it's much higher if we really are able to measure all the unofficial forms of money lending that actually happen in this country. So you're really dealing with a high debt ratio, and the only way it gets sorted out in most economies is through a reduction in the debt to GDP through inflation. That's usually the choice. Default is usually not a choice, and especially if it's a sovereign issue, then it's definitely not a choice. You always try to inflate debt away, and that is what, if you saw for the last several years, we were tightening our fiscal deficit, which means growth had to slow down, and I kept writing about high interest rates and slower growth. But the markets continued to do well, and the reason is that markets always respond positively to inflation. And so coming back to the idea that this government was brought in on the idea that inflation is an issue that they would address. My expectation was they would do a lot on the agro side, and they have taken measures in terms of getting food distribution to get better, so that food inflation at least cools off. And till that's going on, inflationary forces are existent in many other areas, and while food can be a significant cutoff, you can't simply go around splurging money and getting inflation back in other aspects or other components of inflation. So that is why I expected that it would be disinflationary, and markets typically don't like disinflation. They would really like inflation. They would like you to keep printing money, keep spending, more OMOs. Most people also don't understand that OMOs, or open market operations done by RBI, are nothing but quantitative easing of a kind that is done in the US. So we've been doing QE for years now, and a lot of that money has been partly because of some of our inflation, apart from supply side bottlenecks that are so much talked about. So here we are, moment the railway budget was presented, I think it became apparent to the market that the disinflationary path was quite strong, and the market started correcting well ahead of the union budget. Otherwise, it's typical that markets peak out by union budget day, and if there were positive announcements, there was room for a spike up, which is why, even though I was anticipating an ending diagonal more than a week ago in my Nifty daily updates to India Charts Insiders, a week back in my long short report, I opened up the possibility, if there are some extreme positive announcements, and you can't know what that would be. What if a sort of spending or a reform oriented budget did come in, changing many more things than they did, you could get a spike up. But again, being disinflationary, I think it would have led to some kind of selling later, because while you can be policy positive, which means that you've opened up a lot of things, you've left everything to happen on its own. Now there's both the good and bad side of it. The good side of it is, to me, open markets are really the best thing to have. So I think they've moved towards open markets. You allow entry of participants into every part of the market, and let the markets decide. If investment cycle has to pick up, it will pick up on its own. Now you can bank on it, but the question is, do you really drive the investment cycle? And that's where Keynesian theory comes in. If the economy is slowing down, you spend money and grow it. But do you do that at the cost of inflation? And when inflation has become such a big problem that we've been hitting double digits on CPI for so many years, somewhere that is not working, and it's making people upset, because inflation is finally catching up with the growth in incomes that we saw in the previous decade. And so that path is not really the one that is going to be chosen, and if you're leaving it to people to for what is also called the nature's forces, or it has been mentioned by a couple of people that let the animal spirits come alive. Now essentially when we study Elliott wave, when we are studying mass psychology, we are really studying in the markets herding. All these cycles are about herding. But when you say that let the animal spirits drive the markets, or rather, if the markets go up, the animal spirits will come back, what you're really doing is you're hoping that the trend will change. But if the trend of the herd has actually changed from inflationary to disinflationary, then that's something you can't change. You can't change it. It's going to take its own course, and but you can step in and change it through inflationary measures. That is, if you actually do a QE and print money like we've seen in the United States. So that sums it up. That tells you essentially that the forces were definitely not there unless the government decided to go completely out of control. And and if they did, then definitely you could have got a spike up to 8,400 or higher. The fact is that they didn't. It became apparent on the railway budget day, and then later on the budget day. Now you have all the people who've turned extremely bullish, saying, well, this is still a bull market, you need to buy the dip. And I'm not so sure of that. If it is a dip that you should buy into, then I think you figure it out once you've had the correction, and if the market actually stabilizes above the 61% retracement mark, which is somewhere around 66.50. Now that's an extreme. It's possible you stabilize even higher if things are all well. So those are levels that you want to watch for on the way down. We don't know how far we are going. But the part that I would like to get people to think about is that if you have an ending diagonal, which is a technical pattern that only occurs when an entire trend ends, which means the entire rally from Feb ended, the question that we would raise is that is the fifth wave over? Is this going to develop into a bigger bubble? Bubbles typically extend all the way till historical price earning ratios hit the 30 mark as far as India is concerned, and I also showed the relative strength of mid caps goes significantly higher, even though they've done much better than the main indices in the current run up. They haven't reached the upper end of the range based on a measure that I've been following, which is the Sensex with the CNX mid cap, and we are still at a PE ratio on historical earnings in the early 20s. We didn't really stretch to the upper end, and so you can either say that no, this is a bubble that will keep going on because a lot of money flow will come in, or money will eventually get spread into the economy through by the government, and none of which is visible in the budget, by the way. So which means you're purely depending on foreign flows to make that happen, and foreign flows would be completely dependent on what is happening in world markets. And so if I take the discussion to world markets, what we've seen since January of this year, almost for maybe a year, is several sentiment indicators of the long term going into an extreme on the US markets. And essentially from January, the US market has been making doji patterns, very small candles on the monthly charts. So I actually thought I should do a test when I saw the monthly chart as to whether this has ever happened before. And I plotted an indicator measuring the open to the close for each month. And I found that since January, for 4 consecutive months, that is the last 4 months, which is June, May, April and March, these 4 months consecutively had the smallest open to close difference. And in percentage terms, I'm not talking in point terms, consecutively ever in the history of data that I have all the way from 1928. Okay, and that's for the Dow Jones. So this is the narrowest volatility. When you look at monthly momentum indicators, even though there's been narrow volatility, the US has been closing higher month on month. But momentum indicators are already in the sell side because this very slow movement has pushed basic momentum, which is like a weighted rate of change, to cross over with its moving average to the sell side. And this is also visible in some of the European markets, many of which on the weekly charts have gone into sell this week, apart from the monthly or degree as well. The US, of course, still held out on the weekly degree, and essentially we are seeing probably the potential of starting one of the deepest corrections of more than a year that we've seen this ongoing, almost 1.5 year or 2 years, you can say, 1.5 year I would say, run up in the US market without a significant weekly degree correction, because the weekly momentum cycles have just not come back to zero. They've just continued to stretch, giving a lot of false buy and sell signals along the way, but not really stretching. So that's the entire perspective, that you have weak global markets. They haven't started selling off just until now. The European markets led, so I wrote an entire note on European markets more than a week ago. The US markets are showing some early signs, but they are still to confirm at the weekly degree. Whereas our own market, which was holding out, has confirmed weekly sells this week because of the sell-off that happened after the budget. In a sense, because we have a disinflationary budget, I think my thoughts go right back to where they were 6 months ago, that the winter cycle is not complete, and if nature's forces, that is the herding cycles which are showing up on Elliott wave patterns, are still playing out as they were, and there's no external interference in terms of printing money and so on, even from at our domestic level. We are still working on getting inflation down and then getting interest rates down and then kick-starting the investment cycle. If that's essentially what we are looking at, then I think you're looking at much weaker markets and a deeper correction first before things improve. So you would like to see 6650 hold definitely if you want this uptrend that started to continue just after a correction or a retracement. There's also the 20-week average at 7010. But watch out. I would be looking at whether these levels hold. I would be looking at whether these levels break, because my sense is that if the fifth wave truncated, we didn't go into extreme bubble territory, and if we really ended something because we already have an ending diagonal, which means that we are not going into that mode, then this trend itself is over. It's either over as a complex corrective starting all the way from 2012, which is how I was marking it, all the way till even March, that is that this current up move is a wave C of an ABC that started from the bottom in August, or you can take this entire period as what we call a running triangle, similar to what happened in the 1990s. In the 1990s, a triangular pattern did form and you broke out to the upside in what was the Y2K bubble. At least the Y2K bubble was Y2K oriented, which means you had a tech sector that was growing at 100% in terms of earnings growth. Valuations did go overboard before it ended, but you had an underlying fundamental theme that was driving that move. Right now, what we've had for the last 9 months has essentially been that the markets fell too far on valuations. Many stocks became cheap, they were at discount to book, and that drove buying into them. And even as markets paused in Jan and Feb, they again took off in March in expectations that the new government would actually do much more than they have done. And because that has not come through, this move could have ended the fifth wave here as well if I take the entire period as a running triangle and fifth wave. So if I just say it's mimicking what happened in the 1990s, what I don't have in this case though is that we didn't enter valuations which are of bubble territory, and therefore if this is not a bubble, I don't know whether I should mark it a fifth. And here's another thing from a pure technical perspective, and this I've seen in many long-term stock charts and probably for the first time in the index itself. If I mark this entire period from 2008 to 2014, 13 as a triangle, as a running triangle, it's an ascending triangle, and I've seen this many times in stocks that when ascending triangles occurred, in the fourth wave, and especially at a larger degree, multi-month or multi-year degree, then the fifth waves often failed, which means they broke out, you had a fast rally, but they reversed quickly and went well below the triangle breakout range, which was at around 63, 6400. That typically happened in so many stocks in the 90s when I was even not doing Elliott, that I noticed it as a pattern that ascending triangles before final advances lead to a quick run up and then the failure, and I found even the textbooks call it something known as an end run. A triangle breakout comes up with an end run in the classical textbooks, and that rally typically ends and the prices just fall back and it ends up being a failure rally, though it does give you a big move up, a good move up. In terms of the size, when you see the previous pattern, it ends up being much smaller. So if you see 2008 to 2013, a very big consolidation phase, and then you see this very small run up in which a lot of stocks went up sharply, and then it suddenly just reverses and falls back right from where it started. That's something I've seen many times in stocks, and which is what I would watch out for, because if 6650 breaks, you start testing the 6400 level, and then you're back into, and that would then confirm that yes, this was either a fifth or a C ended, and not what the bulls would like to believe, that is that this is a bull market and probably just a fourth wave correction, should not go below 7,000, 7,200. So I think that's a serious risk. I would be going back to my counter-type winter phase expectation that each and every sector in the last phase, and that is similar to what happened after 2000, the Y2K ended. From there to 2001, approximately 18 months, you had a phase where almost everything went down. But at the same time, because you were ending that business cycle and there were a lot of other sectors that had been falling for a long time, stocks that went up in 5 waves only did retracements during the Y2K bust, which means that index went back from 6,000 to 2,500 by September 2001. But in that time period, a lot of stocks that had gone up, like say even ACC, which bottomed in 98, went from 90 rupees all the way to over 300 rupees. It retraced 80 to 90% of those gains, but did not break the 1998 low, and that was same for Reliance, that was same for Tata Power. They went down through those bear markets, but they held, they made a higher bottom through that bear market, and therefore their longer term bottoms had been put in place. So that's the reason that I thought that the value buying phase really started in August of last year. It's possible there are some companies that during a sell-off now do not fall to new lows, but at the same time, if we are in a weak phase, we can see significant downside in individual stocks. There will be others which will have only completed X waves during this run-up and will do their Z waves, which means retest the lows in those stocks of the lows that they made in August of last year. So there will be a complex mix, but I think there will be more weaker names than stronger ones, and definitely the strongest ones like the defensives will actually do pretty poorly, because that's probably one area where I can say the bubble money really went and all the asset has gotten allocated to that particular segment, FMCG, pharma and ID, and probably auto to an extent, because the auto cycle, even though turned in terms of sales, and turned in terms of stock prices. So those would be areas where selling pressure could end up being higher during this down cycle, as those sectors peak out versus others that may have maybe in final legs or may have bottomed out. So that's the overall picture and outlook that I have after the budget. That essentially keeps everything in terms of macros and the thought process the same, but you definitely had a market that's seen, because of the money flow and value buying, a huge upside in the last 9 months, and because of the existence of an ending diagonal, I believe that that period is over and you're going to be going through a much rougher patch in the months ahead, both because of while we are sorting out our domestic issues, we'll be facing significant global headwinds. So that's all in this update from me on this video, Sunday the 13th of July 2014, and that's it.